Hard conditions in the insurance-linked securities market are persisting as investors have not gotten over the sting of severe catastrophe losses in recent years. Here to discuss the ILS market, part of AM Best's annual look at the global reinsurance industry, is Emmanuel Modu, Managing Director, ILS. And Manny, the report notes that cat bonds have been a bright spot in the ILS market. Putting cat bonds aside for a moment, what's the current state and size of the ILS market?
The ILS market's capacity is currently around $99 billion, which is about 28% of total global reinsurance capital of $560 billion. $99 billion represents a growth of about $3 billion from the 2022 levels. Over the past year, there's been really an overhaul of the ILS market. First, overall rates have dramatically increased by about 30 to 40%, as reflected in the Guy Carpenter Rate Online Index. Secondly, ILS managers have increased attachment points of reinsurance transactions, and to some extent this has partially insulated the ILS market from mid-sized losses such as those associated with Hurricane Idalia and the Texas windstorms. Thirdly, ILS managers are focusing more on well-modeled risks and are trying to avoid secondary perils, which have been problematic for the market over the past 5 years. So overall, things are moving in the right direction, but it will take some time to draw a lot more investors back into the ILS market, given the losses investors have experienced over the past few years.
So what's driving this high issuance of cat bonds?
Cat bond issuance through the first half of 2023 was about $10 billion. By year end, we think the figure will probably surpass a record of $12.5 billion in 2021. There are a few reasons why the issuance level is so high this year. One is that investors have shown an appetite for more remote risks, and cat bonds satisfy their requirements. Investors like the fact that cat bonds have well-defined risks. Some bonds are designed to trigger based on named weather activities, and they can often avoid secondary perils, which has been a problem for the industry for the past 5 years. Secondly, there have been improved loss multiples with cat bonds. A loss multiple is spreads divided by losses, expected losses. This indicates that investors are getting higher returns for the risk they're taking, and loss multiples have basically doubled since 2021. Thirdly, the returns of cat bonds has been quite stellar so far this year. So in the first half of 2023, the returns have been about 10.3%. Now through August, the return was about 14%. Now these returns have been somewhat boosted by the fact that the market overreacted to the effect of Hurricane Ian on cat bond prices in 2022. So the returns this year are being enhanced by the recoveries on those cat bonds. Of course, hurricane season is not quite over yet, so we don't know what will happen, but we suspect that by year end, if there are no major events, the cat bond returns this year will surpass the record of 15.4% in 2007. The fourth reason why we have such a high issuance level this year is that there was a bumper crop of cat bonds issued about 3 years ago. Because cat bonds are 3-year instruments, many of the maturing bonds this year from that cohort of bonds will probably be reissued by their sponsors.
Manny, do you expect to see this growth continue?
As long as supply and demand dynamics are out of balance, the growth will continue. We know that demand was quite high for cat bonds in the first half of this year because cat bonds were being upsized. The offerings were upsized by about 49%. Growth will also continue as long as the market maintains the discipline to give investors more confidence in the sustainability of profits. We know that even though the average loss multiple came down a bit in the second quarter, it's still pretty high by historical standards.
So trapped capital has been an ongoing issue. Is that persisting?
Yeah, well, trapped capital related to hurricanes Ida and Ian continue to be a problem for the industry. The estimate is that of the $99 billion of ILS capital, about $10 billion to $15 billion is trapped. Now, from the perspective of cedents, trapped capital is actually a feature of the ILS market, not a bug. In essence, cedents don't want collateral returned too early to investors before losses are fully developed. Now recall that cedents are transacting with special purpose insurers that are unrated and have no real equity. The only capital they have is to support the reinsurance transactions with the cedents. So any capital return to investors automatically triggers computations of the reinsurance contracts. This leaves cedents vulnerable to tail risk. For this reason, cedents are likely to be very conservative with loss picks associated with certain perils. Now, the mechanism for controlling trapped capital are called buffer loss table factors. They determine the reserve buffers to be held in collateral accounts. So we are seeing that these factors are now often being negotiated more actively by fund managers. And for the first time, we're seeing that buffer loss factor tables are being included in cat bond transactions because cat bonds also experience collateral trapping. Ultimately, there has to be a meeting of the minds between investors and cedents to keep the capital flowing into the reinsurance market.
Got to ask, how are investors looking at the ILS market?
Well, I think some investors have a wait-and-see attitude to see if price increases are sustainable. Many of them feel that they have not been adequately compensated for the risk that they've taken over the past few years, especially with regards to exposures related to secondary perils. Also, investors have a lot of questions about how much climate change has affected the $500 billion of losses over the past 5 years.
Manny, what are you hearing about the supply of ILS capital, and what should we expect going forward?
Well, insurance insiders still believe there's an imbalance between supply and demand of capital. We simply don't see any indication from the ILS managers that they are expecting a lot more capital flowing into the market in the short run.
Thanks, Manny. That was Emmanuel Modu, Managing Director, ILS. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.